So we continue with objective 3.3, adjusting the accounts. We're going to look at some accruals, and by that I mean a type of accrual accounting accrual, where we recognize the expense or revenue now and the cash later. So here are the facts. The end of the fiscal year is Friday. Payday is Monday. All your employees and employees of the corporation earn $10,000, but they don't get paid till Monday. All right, so it doesn't matter whether or not they got paid under a big A accrual accounting. We're going to recognize the $10,000 as salary expense. And what are you going to do over here? Salary expense, if it's something you owe but have not yet paid, it's a liability. We're going to call it salary payable. And there you go. Here is interest expense. The first fact we're told is they received $10,000 in cash in exchange for a 12% note. So we're getting cash and we're giving a promise to pay, which is a note payable. And the amount was in $10,000. Now we're going to record interest expense. So, in general, interest expense, and this is for simple interest where it's not like a car loan where you're making the same payment every month. Part of it is interest and part of it's principal. That's an amortizing note. This is interest only, and then you pay the full amount you borrowed at the end. So this is just a simple interest calculation. So you start with in general, it's principal, AL, times, let's see, the interest rate. And this one is going to be times, let's see, it's July 1st again, so it's 6 out of 12 months. That's getting ahead of myself there. Then when I do that, what I want to do is times number of months accrued over 12. So in this case, we're going to have 10,000 times the interest rate times 6 months over 12, which equals 6,000. Okay, so that's the amount. What are we recording? Interest expense. Expense is a debit. Something that we have to pay. We have not yet paid, but we owe it. We have to pay it. It's a payable. And there we'll put our 6,000 and our 6,000. Okay. Here's an example of accrued revenue. So same as before, except this is the flip side. On the other side, the corporation was borrowing. Here, this is like a bank. I didn't quite change this. The facts have to be changed a little bit. So here they say they paid 10,000 in exchange for a 12% note. So they gave up 10,000 cash and they received a note. So it's a note receivable is what they're getting. So for most of us, when we talk about loans, we think of them as things that we have to pay back. For banks, they're investments. So that's a note receivable. And when somebody borrows, the bank gives them cash, or a corporation or a person. So that's 10,000. Now we're going to record interest revenue. Interest revenue is a credit, so let me put the credit down here. Remember, it's debits, then credits. Revenue is a credit, and it will be the same calculation as on the prior slide. So their expense in the prior slide is the bank's revenue, and debits will equal credits, so it's 6,000, 6,000. So what is it over here? If somebody owes us something and has not yet paid, well, it is interest in this case, but it's always, if they owe us and haven't paid, it's a receivable. So interest receivable, interest revenue, there is an example of an accrued revenue. We're recognizing the revenue, but we have not yet gotten paid. That's what makes it an accrual. And I got the wrong row there, I just noticed. 6,000, all right. I think that does it for our accruals. Oh no, I take it back. Here's another one, very popular, common one, unearned service revenue. So you receive $12,000 in exchange for cleaning an office building for the next 12 months. And you got that on October 1st. So you receive $12,000. What are you receiving? Cash. What are you giving? You're giving a promise to provide a service. So we're going to call that account unearned service revenue. So if something happens where you close your company, you'll be liable to pay them the money back. All right, and the amount is 12,000. 12,000. Record service revenue down here. So if it's 12,000, here's the service revenue per year. So revenue per year divided by 12. That's the number of revenues, the amount of revenue per month times months of service. This is revenue earned in current year. So it's a 12,000 12-month contract. So revenue per year is the is what I'm calculating. All right. So this is dollar per year in contract divided by 12. So this here is revenue per month, and then you multiply it by the months of service. So in our case, it's 12,000 divided by 12. October, November, December times 3. That should be 3,000. All right, we're going to record revenue, which is a credit of 3,000. And the question is, what account is debited? Well, we're going to reduce the liability unearned service revenue. So if you look at these accruals, you may notice in this last one, what we did was reduce the liability recognized service revenue. And the interest revenue, we recognized an asset and recognized revenue. In the interest expense, we recognize expense and recognize the liability. And then for the salary expense, we recognize expense and also recognize liability. So these accruals and deferrals will have an expense or revenue and then a liability or asset account included. All right, and that definitely is it for the accruals. In the next slide or video, we'll go through depreciation.